The biggest trend that we think is inevitable, I couldn't tell you if it's this year, next year, 10 years from now, but it will happen, is the converging of retail investor demand and private markets. In some sleeves or pockets of the private market ecosystem, you're already seeing this. And we think it's inevitable that it hits every single sub-market within alts.
All right. Hey, Javier, how's it going?
It's going well. Hey, Ed, how are you?
Very well. Thanks for joining the Trends with Benefits podcast. And I'm looking forward to our conversation. You know, I think when we talked, we're going to tackle the VC secondaries market and all of the things related to that, as well as your company Caplight, which I think is super fascinating. By way of introduction for the listeners and people on YouTube, I'm speaking with Javier Avalos, CEO of Caplight. And as I mentioned, we're going to talk about VC secondaries and what's kind of happening in that market. But where I kind of wanted to start off first, just because it's kind of in the news with Elon Musk and Doge. And I even heard on the headlines today on CNBC, investor concerns or Tesla investor concerns with as much time as Elon is spending with Doge. And I think Tesla, as we record today, was down something like 16% year to date. I know you guys track an index of his other companies as well that includes his other companies on in the private markets or the secondaries markets. Have you noticed a notable impact from his based out of concern for his involvement with Doge and all the time he's spending there?
Yeah, it's hard to resist not starting with Elon, right? Just considering the amount of headlines the man seems to make on a daily basis. Well, first of all, Ed, it's great to be here. Thank you for having me. Excited to get into the conversation. On the Elon index in particular, it's interesting seeing the dynamic with Tesla included in this index that we track. So just for the listeners out there, what we do here at Caplight is track secondary market transaction data. We're basically following the stock prices of private companies, VC-backed private companies. These are usually like unicorn type companies. Good examples would be SpaceX and XAI, which happen to find themselves in this index. The Elon index that we're tracking is an equal weighted basket of Elon Musk founded, or basically where he's CEO of the company. And so it does include Tesla, includes SpaceX, XAI, Neuralink, X, a Boring Company. And we actually equal weight this index. And so, you know, your point is dead on. I think in the public market, Tesla has been beat up a little bit because of reactions around the amount of attention that is being devoted to that company. In the private market, we're seeing a different trend. The Elon index overall has had like a fantastic price performance. If you go back a little bit further than just this year, and you look at the second half of 2024, the basket of stock that we track that makes up this index was up a little more than 50% in the second half of the year. Over the same time period, the NASDAQ was up less than 10%. Most of that performance in the Elon index was really happened at the tail end of the year, right? So it's like November and December. We all know what happened in early November here in the US. 30+% of that 50% performance can be attributed to that 2-month span, whereas NASDAQ was relatively flat. I think it was up about 4% over that same time period. And despite some of the weakness in Tesla this year on the stock price side of things, two big constituents of the index in SpaceX and XAI have continued to go up and to the right from a price performance standpoint. Some of that is driven by new fundraising dynamics. So SpaceX announcing a really large sort of up round towards the end of the year. And some of it is driven by thematic. So XAI benefiting from all the tailwinds that are sort of befitting of any of these foundational model plays at the moment. In SpaceX, I think investors are looking at like a deregulatory environment for the next 4 years. And so you have these strong positive trends really overcoming the weakness in Tesla. And so we have the Elon index sitting higher than where it closed last year.
Yeah, it's super fascinating. And also for the reason that you're able to see and get a sense of the price performance of these still private companies where, and I think you posted about this too. There's an interesting article on Bloomberg that talked about how the public markets are going dark. They're going into these dark pools or into where you can't get quite the same transparency as you used to. And what was it? Something like 52% of all U.S. volume is kind of off exchange.
That's right.
I thought it was an interesting, I guess, dichotomy, if you will, if that's the right word, or contrast to what you're able to do and what you're seeing with your company. Maybe this is an opportunity to talk a little bit about that and kind of what's happening in the public markets.
Yeah, and I first of all, I credit that analysis to or the report rather to Bloomberg. I think that their reporter did a great job unearthing that trend. It's interesting. We think about like the public stock market as really this beacon of efficiency and in liquidity and transparency and all of these E's that sort of make the market institutional, such that a typical user of the market, a typical investor who maybe has some equity exposure in a retirement portfolio, they don't have to spend much time thinking about how their financial advisor or they themselves are going to go about acquiring the shares that they want to buy. If they want to buy Tesla or Apple or Nvidia, that's as simple as clicking a button on an app. But there is an entire machine that is working in the background to make sure that order is transacted on efficiently. And I think what that article on Bloomberg unearths is something that we experience in the private markets every single day. Transparency and price discovery are really core tenets of a functioning and efficient market. If you do not have confidence as a user of the market of what the next price of an asset is going to be when you want to actually bid on it, it makes you a lot less willing to go into the market and have enough confidence that it will be a reliable place for you to get basically for you to buy your stock. And in our view, and this is sort of the house view at Caplight, transparency in terms of being able to tell all investors and users of a marketplace what the price is of an asset at any given time is the key thing to unlocking more dollars flowing into a capital market. And so when I see the public markets going dark, I think to myself, are these worlds converging? Is the private market sort of getting brighter while the public market is getting a little bit darker? And over time, at what point will those things be equal? That's what we spend a lot of time thinking about here at Caplight.
Yeah, it's super fascinating. And what have you been seeing in the VC secondary market? I mean, that's a market that's just not started, but it has been growing tremendously, right?
It is, yeah. So before getting into the growth that we've seen there, which has been really large, as you pointed out, Ed, maybe just to spend a second defining what this market is. VC is a massive ecosystem at this point. We have the total sort of size of the VC market, capital market, any given year, which is really just the amount of money VCs are raising, the amount of money they're deploying, and the amount of secondary that's happening at north of $500 billion of transaction volume a year. The total value of all unicorn companies is somewhere around $5 trillion. So it's a pretty sizable slug of the alternative assets investment universe. The place that we spend time here at Caplight is on the secondary market side of things. Similar to the public stock market, the private market has a functioning market where if you are an existing owner of private company stock, you can sell your shares ahead of those shares being listed and publicly traded. This, to your point, Ed, started as a bit of a cottage industry. Our friends at Industry Ventures have a great report that's pretty recent. We use this as our North Star in terms of market sizing. Industry is one of the OGs, if you will, in secondary market venture investing. And they sized the market in 2012 at around $25 billion in total volume for the year. And looking at last year, they had the market at around $120 billion of volume traded. What are these actual trades? These are situations where venture investors or shareholders of these private companies, so your employees, your founders, etc., are interested in selling their stock before the company is publicly traded and use the secondary market to find a buyer that can buy those shares from them. So that's what this $100 billion or so measures. That growth is fantastic. That growth has outstripped many of the other asset classes that are out there. We think the market's going to continue to get much bigger, just in terms of the amount of companies that are staying private longer, the amount of fundraising that is being dedicated to vehicles specifically targeting secondaries, and just the fact that this remains one of the only places in the capital market ecosystem where you can find truly innovative, game-changing companies and reap the reward of taking that risk.
Yeah, it's super fascinating because I guess the number of companies going public, as you mentioned, more companies are staying private longer. Is that another reason that's really fueling the secondaries market, where investors, for whatever reason, kind of reach their time limit and want to get that extra liquidity? Do you foresee the market evolving so where we'll have more of that? And I don't know if the IPO market will come back in a form or fashion that we remember back in the day.
Yeah, I mean, all signs and all data that we track and that we consume from others point to an increasing VC secondary market over the coming 5-10 years. This is a sort of structural change that we think we're still in the pretty early innings of. So we're excited about how big this market can become. And I think the reasons for the market, there's sort of the short term and the longer term dynamics that are at play here. In the short term, you've seen the IPO window being shut, to your point, which has sort of resulted in this like growing queue of, in some cases, really, really strong, high performing VC-backed technology companies that investors are just looking for a channel to get into the equity, like into the stock, while these companies continue to be private. And I think for many investors, folks are expecting 2025 to be the year where the unicorn herd kind of beats down the door and starts to stampede into the public markets. We saw a lot of buy side of the market coming back in the fall on the back of declining rates for the first time in a little while, expectations of administration that's a little bit more hands off on the regulatory side of things. I think investors are excited about IPOs and therefore are trying to sort of get into those stories before the companies are public, so they can reap some of the hoped upside that comes with that. So there's a little bit of like a short-term dynamic of, okay, the IPO window has been shut for the past 3 years. Investors are looking for another avenue to kind of get into some of those innovative tech companies. Secondary market is a really good place for that to play out. I'm a lot more excited about the long-term trends that are at play here. If you look at the VC-backed private market versus the public market, this shift has been taking place for decades already. And the shift that I'm talking about is the market sort of evolving from just publicly traded to looking at private companies as sort of like a big part of the investable universe. So what do I mean by that? In 1992, there were about 8,000, there were a little more than 8,000 publicly listed companies here in the United States. As of the end of last year, that number was closer to 4,000. So the addressable market of like public stocks that are out there has been cut in half. And this is research that Apollo did. In the same time period, the number of private companies here in the US, again, that are VC backed has exploded from about 4,000, again, in the early 90s to more than 30,000 at the end of last year. So IPO window being shut for a couple years here and there, like, yes, that sort of helps with getting transaction volume done in the near term. But I think what this trend has been alive and well a long time before the IPO window slowed down. And when you look at it, it's the behavior of these private companies that has become the expectation that is really driving this. So when you look at the average age of unicorn companies here in the United States, the average age is over 8 years. The average shelf life of a venture fund is about 10 years. Then you have sort of year by year extensions that you can reach with your LPs as a venture investor. But when you start to get into year 8 of a VC fund, you start to think about, how do I return capital to my LPs such that those same LPs will back my next fund? And now, if you're not considering the secondary market in that conversation, you're sort of jeopardizing your entire core business model as a venture capitalist of having cash to deploy the next time you're in the market trying to raise a fund. We see this being a secular trend that that the market benefits from.
So becoming a core part of the decision to launch a fund or the operation of a fund as opposed to kind of an afterthought later on.
Exactly right. And we put out a piece earlier this week even that sort of titles this like the chief liquidity officer of a VC fund. Like this role didn't really exist, and now we're consistently seeing the smartest, most forward-thinking VCs, the VCs that behave like asset managers and not folks that are just using relationships to find the next Sam Altman or Elon Musk. The folks that are treating venture like a business are in-housing a role or several, like a whole team, whose job it is to think through liquidity across the portfolio. Sometimes that means advising their portfolio companies on how they should go to market and actually complete an exit, whether via an IPO or an acquisition. And sometimes that's trying to consider what their own liquidity solutions might be to return capital to their investors. And that might mean selling in the secondary market. That might mean doing some sort of continuation vehicle, et cetera. But the fact is, this is a relatively new type of role that didn't previously exist in Silicon Valley. And when you have thought leaders like a Lightspeed or an NEA out there, having a dedicated resource for something like this, the rest of the venture capital community takes note, and that becomes the new playbook.
Now, when they're trading in the secondaries, the venture-backed companies, what round of shares are you tracking, or is that an appropriate question?
It is, and there used to be an appropriate answer to it, and I'll tell you why. I'll tell you why the old adage response that I'll give you in a second doesn't make a lot of sense anymore. It used to be a good rule of thumb is Series D as in dog and later, and or $5 billion valuation and higher is a good barometer to use if you are a shareholder of one of these private companies, when there may be an investor on the other side of your interest to sell your stock. And that worked for a while, and it especially worked in a market environment like we had in 2018 to 2021, where any investor coming into a round had a reasonable expectation that the next round that happened was going to mark them up. The biggest change to VC market dynamics that has happened in the last couple of years is AI. And suddenly, the Series D, the old adage of like Series D and later goes out the window when you've got a, Series A company doing over $100 million of ARR, raising at a, 5, 10, $100 billion valuation. Suddenly the market is clamoring for those shares and couldn't get into the round that was highly oversubscribed, and is now looking at the secondary market as a way to invest and buy directly from existing shareholders, potentially de-risking those shareholders.
Are you seeing trends in terms of what types of shares are coming to market, what investors will pay a premium for, or is it really just kind of dependent upon the company and the outlook for the company?
Yeah, this is something that we track pretty closely here at Caplight. This market is very large and growing, as we've discussed, but it is incredibly fragmented. The way that this asset class trades is it resembles real estate a lot more than it resembles public stock trading. And the reason that is relevant to your question is it used to be that in order to get the best market pricing, you had to know the best broker. You had to be able to find the right broker to help you buy or sell, and that broker was going to represent you and get you the best price in the market. What we've done here at Caplight is we've aggregated all of these brokers into one central platform, right? So in the same way Zillow does a good job of aggregating, thousands or tens of thousands of independent real estate brokers to kind of get a sense for where homes are actually trading at or selling at rather, and where there's new inventory available. Caplight does the same thing of aggregating hundreds of brokers who are specialized in doing pre-IPO secondary market trading into the same place, getting their recently closed trades so that we have a ledger of what has actually traded and at what price, as well as their inventory, which includes where their customers, where their end clients want to buy or sell. So to come all the way back to your question, what we're trying to do is make it a lot more clear which private companies are trading at which levels compared to their last round than has ever been done before. And generally what we're seeing is companies that have raised a new round in this new funding environment will tend to trade pretty closely to that new round price. So if you've raised a new round, and the environment I'm talking about is really like the post-ZERP era. So think about this as like June of 2022 and later. If you've raised a funding round or as a private company or done a price tender round, chances are your stock is going to trade pretty close to that. If you're one of these high-flying AI companies, especially one of the foundational model plays, your OpenAI, Anthropic, XAI, you're going to be trading at a premium to where that last round was. And this has more to do with like scarcity of the actual shares. If you are not in the category that has raised a new priced venture round in the last 3 to 4 years or so, and your last round was done in the 2021 and previous era, chances are your shares are trading at a very large discount on the secondary market if they're trading at all. So to quantify this, like companies that fit into this category, we've seen discounts to the company's last funding round at upwards of 70%, right? So the range that I would give would be like 50 to 70% down off of where the latest funding round came in.
Not to make you talk about competitors, but maybe talk about yourself and relation to, you mentioned others out there that perhaps are providing some kind of transparency into the pricing movements. Tell me a little bit more about Caplight and what are the other features or abilities that a subscriber might be able to access?
Yeah, totally. I love talking about competitors because our competitors make us better. So it's all good. The way I like to think about I spend a lot of time, as you've realized by now, talking about like asset classes that are similarly traded to private markets, to pre-IPO, that is. I still look at the public market as a North Star of sorts. Like when I close my eyes and like dream about what pre-IPO investing could be, I often go back to like the stack that exists in the public markets. The vertical stack that I'm referring to is like what is the machinery that happens in the background when you want to buy your Apple stock and I want to sell you my Apple stock? Like how does that trade actually consummate? And there are several layers to this. And I guess just to simplify it, the top layer is going to be that brokerage layer. Like I'm going to go into Robinhood and click the sell button. You're going to go into Schwab or maybe Goldman if you're a high roller and click the equivalent buy button. That's like the first layer. Which brokerage shop or app or whatever, however you want to define this, has the end customer relationship. Below that, you've got an exchange and dark pool layer. If that brokerage can't find the other side of a trade within their own client book, they can access a broader client book in terms of like accessing a central exchange, which sort of coalesces all of the orders that are coming from every other brokerage. And same, ditto that statement for like dark pools and ATSs. Under that, assuming that there's been a match on this order, you've got like an execution settlement layer. So this would be like the DTCC in the public markets, something that ensures that actual units, like assets, transfer. And then you've got sort of custody and collateralization. So like a feature in the market that makes sure that every participant in there has some credit worthiness to engage in that type of transaction. Those are like 4 distinct layers of the public markets, right? Very, very simplified. I think for the longest time in private markets, specifically in pre-IPO secondary market trading, any player in the space has tried to be the full suite, like the entire full stack for the pre-IPO secondary market. And I don't think that's the right way to think about it, at least not while the market remains as fragmented and relationship driven as it currently is. And so what makes Caplight different is that we have made a declaration to the market that we do not want to be every layer of the market. We do not think that we are uniquely positioned to be every layer of the market. We want to serve as that exchange, ATS, and data layer that sort of sits behind the brokerage layer. What that means is we don't feel the need to go own every end buyer and every end seller customer relationship. The reason that is incredibly beneficial to the other market players that are out there is because if you are a brokerage house and we are saying we do not want to own all your end clients, you now have the ability to continue to run your core business without the fear that we are going to go and try and steal all of your end clients and do your business.
You can be a partner.
Exactly. So the way that we partner with the market is we are effectively a layer that connects the different broker dealers to each other. The broker dealers fit into this layer like nodes in the same way that Goldman plugs into the New York Stock Exchange or Charles Schwab plugs into the New York Stock Exchange. It's the same playbook that we're trying to replicate here at Caplight. The benefit is every broker's order book and closed trade data set is being funneled into this exchange layer. That throws off a ton of data and benefits the market by way of just resulting in more confidence when accessing the market. So that's how we position ourselves. I think it conflicts with what some of our competitors are doing, where they have a large in-house brokerage team. At the same time, they're trying to partner with other broker dealers. At the same time, they're trying to sell data. They're doing too many things. And from our standpoint, everybody else operating in the market is going to be skeptical of that business model because it competes with them.
Is that what you saw when you launched Caplight? And by the way, how old is Caplight now?
So we started the company in 2021. The market was at all-time highs. The VC market I'm referring to was at all-time highs in terms of like valuations and liquidity flowing into the market and assets being priced up. And the secondary market was cranking as sort of an output of this. And what my co-founder and I recognized was that we had grown our marketplace so much. We were having success doing more and more trading volume each year. Our marketplace at that time was focused a little bit more on retail investors. The company I'm referring to is Forge Global. It never felt like we were really eating into anybody else's market share. And my role there was head of marketplace. And so it was like, it was really frustrating when it felt like we were having so much success objectively in terms of the volume increasing while we were there, and the transaction revenue increasing because of that. These are like great things. But what always bothered me was like I would catch up with my peers who were trading in the asset class who were not at the company, and it felt like they were doing just as well, if not better than us. And I was like, okay, I took a step back and was like, this market is way more fragmented than I thought it would be. I don't know if we're going to be able to be successful being the one-stop shop for everybody. It feels like there is a lot of trading that's happening away from us still. We need to figure out a way to get all of that into one place, because as long as there are dozens of other broker-dealers out there, and as long as the investment banks are gearing up to start focusing on this space more, I am losing conviction that we will be the place where every institutional investor goes to get their transaction done. So that was really the impetus for wanting to step back on the last company and reevaluate where the market was going and what the best like business model was to kind of like serve the market in the best way possible.
Awesome. That's a great insight. And congratulations on your success so far.
Thank you.
I know I've only got a few more minutes with you, and I wanted to get to some of the fun stuff too, which, all of this is fun, I'm sure. But, with all the information that you're tracking on all these various companies, just going forward into 2025, are there any names that particularly interest you or that you see a lot of activity in, maybe poised to IPO in later this year?
Yeah, it's that last point that gets us really excited. It may be a bit counterintuitive, but a healthy and functioning IPO market, otherwise said as like the IPO window being open, tends to result in a large amount of secondary market activity. So what do I mean by this? In periods where there are many like VC-backed tech companies that are going public, there is quite a bit of volume that happens in the secondary market. The reason for this is twofold. One is investors who are risk-seeking can see a clear path to a company that they're considering investing in before public exit in terms of them being able to actually get liquidity on their position when they invest, right? So the exit path being open helps investors take more risk because they can kind of gauge like, okay, if this comp is going public, I can bet that this company will be marked in the same way in the public market, and therefore may have a clear path to exit in the next couple of years. So that's one. The second is there's just more dollars that are recycled back into the system. right? So when you've got VCs that are able to realize returns, that money goes back in the form of DPI to their investors. Those investors are more likely to fund those VCs' next fund or potentially co-investment vehicles, which sometimes find their way into the secondary market. So there's like this beautiful flywheel that happens if companies can exit from private markets to public markets. At Caplight, we spend a lot of time tracking which companies seem poised to exit. And we do this systematically. So we're a very data-driven company. That's like our core business is selling data and having hopefully helpful insights. We have this product internally. We call this the Caplight IPO tracker that systematically looks for different indicators that a company is gearing up to go public. These indicators can be like very obvious. So a company filing publicly their registration statement, even company confirming that they've confidentially filed with the SEC, all the way to the not so obvious. Has the company hired bankers? Has the company hired a CFO who has also spent time at a public company? Has the company done a cap table cleanup in tandem with these other two moves? If yes, this is going to signal with pretty high confidence that that company is getting ready to do the song and dance of going public. That is a multi-month process. Prior to jumping into startups and focus on private markets, I worked in investment banking. I was the junior analyst working on all these different various like iterations of these S1 documents. Although now, according to David Solomon at Goldman, this can be done with an AI bot. So I'm glad I'm not looking for a job right now on the junior investment banking side of things. The point is, though, that this process takes a lot of time. It's got a lot of steps to it. And when we start to see a company accelerate the steps being taken to complete that process, we get excited because we expect secondary market investment dollars to flow into that company. A case in point would be Klarna. Klarna is a European-based fintech company, and they made some news earlier this year. I don't know if it was them that made the news, but someone made some news that the company has filed and is looking at April as a potential IPO window at a $15 billion valuation. We've been tracking Klarna for months, if not years, on our IPO tracker. We tracked it through its down round in 2022, and we've seen the stock come back. Our current market price is around $14.5 billion valuation on that company, which we're really proud is within 10% of what the company is indicating they're gonna actually list at. So that's what gets us excited. I know it was a long-winded answer.
No, that's awesome. And as we start to close up, what's one long-term trend you see playing out over the next year or several years? It can be about exactly what we talked about, or something totally different, since you have your eye on all these different markets and innovative things that these companies are doing.
Yeah, I think the biggest trend that we think is inevitable, I couldn't tell you if it's this year, next year, 10 years from now, but it will happen, is the converging of retail investor demand and private markets. In some sleeves or pockets of the private market ecosystem, you're already seeing this. And we think it's inevitable that it hits every single sub-market within alts. So what I'm speaking about here specifically is the ETF-fication, if you will, of alternative assets. I think Apollo and State Street have really planted a flag and said, we're doing private credit ETFs. And I look as someone who's building markets and providing market infrastructure for more innovation to occur, like that gets me really fired up, because that gives a clear playbook for anybody who cares about the venture side of alternative assets to say, you know what, we're going to figure out how to do an ETF as well. Venture has been a game that's been exclusively reserved for the ultra wealthy and sophisticated investors. But if we can find the right way as a collective group of market innovators to safely wrap VC exposure within exchange traded funds, I think that this just democratizes the asset class, and it gives the ability for, like, my parents to own exposure to companies like SpaceX, which is really exciting. There have been a few attempts. There are some products out there that look like closed-end funds, but I think getting to a true ETF would be a pivotal point for venture. And we look forward to hopefully having a hand to play in bringing something like that to market.
Very cool. Look forward to the future of that as well. How about a quick round of trend or fad before we close up? I'll just hit you with like 3 different concepts. Get your quick take. Artificial intelligence, trend or fad?
Absolute trend. And I say this as, partial business owner, co-founder of a company. The amount of leverage that we place on these still nascent technologies to help us do our core business of aggregating, cleaning, and distilling hard to get private market data. I think that especially for data-driven companies, your ability to go to market cheaply and like test that idea, the game has changed. Like you don't need to raise VC dollars to go and explore and experiment with this. At the same time, if you are benefiting from a proprietary set of data, your value is also going up because those proprietary data sets are feeding into the same artificial intelligence that is being used by everybody else. So very bullish on this, big users here at Caplight.
I wonder if you've heard of this term, being an entrepreneur yourself, build in public founders. You heard that term? Yeah.
Yeah, have definitely heard it. I feel like this was a ZERP era fad. And I say this maybe from the most biased place possible. If I had to think about building in public at the same time I am actually building, it would just add a lot of calories to to everything we're working on here. And I think it was fun when all like risk asset prices were going up and to the right to be able to say, hey, look how great we are this week, or look how great we are this week. Here at Caplight, we like to take a little bit more of a quiet approach. We're going to be loud and tell you about the insights that we're seeing because we think that's benefiting the market. We're going to have successes in terms of what we're building here a little bit more privately and share them with our customers and our investors.
And then the last one, just kind of given the region that you're in and in California there, I think it's a big trend. Biohacking, trend or fad?
It's funny. If my co-founder was on here, he'd probably say big trend. I guess I'm in the trend camp too. And the reason for this isn't so much that I'm a huge like Huberman head or like biohacker by any means. It's that one thing I've realized being co-founder of a seed stage startup is your body needs to function at all times. Whether that's on like 5 a.m., 6 a.m. calls or like 3 a.m. calls or midnight, whatever it is, like you need to be able to function. And if you don't take proper care of your body, like your machine is going to break down. So I'm a big fan of doing basic things like working out, but also like doing things like sauna, steam room, like having a good supplement regimen, using melatonin to go to sleep, like little things like that, I think are really important to just make sure that you're like taking care of yourself and also like taking time away. We went camping last weekend just to kind of disconnect for like 24, 36 hours and be surrounded by trees. So none of that stuff counts as biohacking, but I think it's in the same camp. Therefore, I'm trend.
Words of wisdom. Javier, awesome. Thank you for your insights. What's the best way for people to find you, learn more about your company, subscribe?
Yeah, absolutely. So our company is www.caplight.com. You can sign up there, and either myself or one of my colleagues will get in touch very shortly. If you want to reach me directly, it's just Javier@caplight.com.
This is awesome. Again, thank you very much for your time, and thank you for listening in to another episode of Trends with Benefits.